Welcome to our latest edition of KPMG's Lunch and Learn series on employment tax matters. The first area of focus in today's session will be the new enhanced employer reporting requirement for certain non-taxable employee expenses and benefits that is coming into effect from 1 January 2024. Keeping then within the PAYE compliance theme, we will then shift our focus to some key employment tax issues that have been receiving a lot more attention and scrutiny from Revenue, and particularly over the last number of months. Today I am joined by my colleagues Thalia O'Toole, John Galligan and Andrew Egan, who will share several insights across the various issues and hopefully provide some useful tips and key takeaways for all employers to assist with the rollout of the enhanced employer reporting and increased ongoing PAYE compliance. So kicking off with the new enhanced employer reporting requirement, or EER for short, this new reporting requirement was legislated for in last year's Finance Act. It requires every employer to report details of certain non-taxable expenses and benefits that are provided to employees to the Revenue on or before the date the expense is reimbursed or the date the benefit is provided. We will come back to the detail regarding what is in scope a little bit later on, but firstly coming to you, Andrew, what is the rationale behind the enhanced employer reporting and what are Revenue hoping to achieve and do with all of the data that they will receive?
Yeah, Olive, I think what strikes me immediately is that with PA modernisation, Revenue have an awful lot of information about what people are being taxed on, but there's probably a gap in terms of what's being paid out to employees that is not being taxed. And I think that this kind of is the first phase of it to plug that gap and to give them the visibility as to what's being now. A lot of it is just reimbursement, so I currently spend on behalf of my employer. I expect to receive that money back, and that's what a lot of this is gathering in. But it's gathering it in then for every employee in the state, and getting details of other non-taxable benefits as well, such as the small benefit exemption. So, like, what are they going to do with that data? Well, I think it'll lead. It'll be helpful in determining compliance checks. So if something doesn't look quite right, Revenue will be able to go and ask the question and inquire. And then at a policy level, it'll also give them the information as to what's actually happening out there, so as that wider policy decisions can be made.
And Thalia, how significant are these changes, and do you think employers are ready for them?
Olive, this is a significant new additional employer reporting obligation, and my sense is that many employers don't appreciate this change is coming, or if they do realise the change is coming, they aren't fully prepared for that change. As you mentioned, Revenue is looking for details around certain tax-free payments and benefits that are being delivered to an employee, and they'll want that information before payment has been made to the employee. So that'll require a significant level of interpretation of data by the employer, provision of that information to Revenue, and consideration as to how they're going to pull that information within the system and deliver that to Revenue by the relevant deadline.
That's it, because I think it might sound like a simple process, but when you actually get into the weeds, there's an awful lot to it to get ready. So maybe if we start with some of the basics, can you tell us what is in scope of the EER?
So the focus here is really on cash payments that are being delivered to the individual tax-free, or as Andrew mentioned, some small non-taxable benefits that have qualified for the small benefit exemption. And in this particular phase, three specific sections will be focused upon. So the payment of the remote working per diem of €3.20 per day, travel and subsistence reimbursements, whether they're vouched expenses or unvouched flat rate sums, and those small benefits such as your vouchers, your small gifts that the employer has previously applied the small benefit exemption to. So on or before the payment date, the employer will need to have collated that relevant data and by category identified the value that's being delivered to the employee and the date of payment or delivery of that benefit for the purposes of the EER return.
So it seems that it's following the kind of payment to an employee or the provision of the benefit to the employee. So what does that tell us then about what's not in scope?
Yeah, so Revenue have indicated that for elements that are already subject to PAYE, they don't need to be already returned. So, for example, if the employer has entered into what's called a PAYE settlement agreement in relation to minor and irregular benefits, naturally they're already taxable. They don't need to be included in the EEOR at this stage. They also don't need to receive details about payments that the employer is making directly to a vendor or supplier, notwithstanding it may relate to travel and subsistence amounts. So, for example, if there's a corporate taxi account in operation by the business and the taxi company is invoicing the employer directly, that does not need to be reported at this stage of the EEOR return. And likewise, if there's a corporate credit card in use within the business, where the employer is settling that credit card bill directly with the supplier, that does not need to be reported on this specific return. So really, employers, as part of the preparation for EEOR, needs to consider, well, of the payments and expenses we're covering for these employees and directors, what will be in scope and what will be out of scope.
Okay, so Andrew, Talia's kind of mentioned a little bit about what's in scope, but what do we know about the actual details that employers are going to have to put into these returns?
Yeah, so like the actual data fields. So I suppose Revenue will need to know who the employer is. So there'll be a couple of bits of information needed in order to identify the employer, but most will be around the employee. So you're looking at typically the employee PPS number and the employment ID, and then you are looking for details of each expense. So you're looking at the date that it's going to be paid, you're looking at the expense type, and there's quite a few of those. There's three main categories, but there's further subcategories, and then you're looking at the value as well. So they're the sort of core information. Now there's a couple of workarounds if you don't have some of that core information around the employee, but that's really what you're looking at.
That's it in a nutshell.
Yeah.
So that's the wash, let's say, right? So in terms of what goes into the return, moving on maybe to the how and how it's reported, just the practicalities, around the data technology side and how that's going to work.
Yeah. So Revenue have said there's going to be three ways for it to be filed. So the first one is very manual, whereby the employer will log into ROS and will go into an area and start keying in information to identify first the employee, and then to put in their expense number 1, and then to put in their expense number 2, and then their expense number 3, and then to move on to employee number 2, and to go on to that, and to do that every week or every time before the expenses are paid. So very manual. Will probably work fine for a very small employer, or for employers with very, very limited expenses, but not practical for medium or large employers. The second, so then there's two more options. One is a bit like, is kind of fully automated, a bit like POI modernization, whereby a software provider will liaise directly. So they'll have what's called an API, but they'll connect to Revenue system directly. And so once the expenses are all approved and everything is agreed upon, then the interaction will be directly from the software provider into Revenue systems, and there won't be any necessity to log into ROS and do that. So that's the fully automated one. And then there's a version in the middle, which I think is where a lot of people will initially settle upon, which is there'll be the ability to log into ROS and to upload a file of all the agreed expenses. And now the file won't be in Excel, unfortunately. The file will be in a JSON type, or so sorry, XML was the one I was missing there. So JSON or XML type file, so that'll need to be created either by a piece of software that the client is running, or possibly using a converter, so something like the ROS Offline tool. So getting that information into that format, logging in, and then uploading that file in order to file the return.
Okay, so I think there's plenty of preparation that seems like it's going to be needed to be ready for that. So Maybe coming back a little bit to the types of things that are going to be reported on. So Thali, you've given us that kind of high level overview of the 3 different categories, but I know within the travel and subsistence, which is probably going to be, one of the biggest categories, because in experience, not a lot of employers are paying the remote working allowance. So if you look at the TNS, travel and subsistence category, what are the kind of prescribed subcategories that Revenue have listed out?
So there's actually 7 subcategories that Revenue are looking for specific information on per employee or director. So they've been identified as travel vouched and travel unvouched, subsistence vouched and subsistence unvouched. Then there's 2 categories specifically focusing on payments for the construction industry, so site-based employees. So you're talking there about maybe country money type of payments. And the second category there would be also the eating on site allowance. And then there's a final category called emergency travel. And that relates to that specific Revenue concession, which allows tax-free home to work travel and vice versa for up to 60 trips per annum per employee once certain conditions are met. So the employer will need to be able to review the data that's being received, either through the expense claim or through payments that are being automated by way of unvouched type round sums to their employees, and to be able to categorise them appropriately for the purposes of this return. So if we add a bit of colour to that and say, well, for example, you typically might get one expense claim from an employee that covers a number of those aspects. So possibly a claim for a taxi receipt to go to a client's site, maybe some hotel and subsistence costs and receipts in relation to a business trip, and then possibly some round sum mileage allowances where I've used my car to go to a client's site. So in that example, there's actually 3 separate reporting categories from the one expense claim. So travel vouched, subsistence vouched, and travel unvouched. So the employer will need to be able to categorise that expense claim, pull out the aggregate of those values by category, and report that to Revenue before they've made any payment to the employee for that information.
So the quality of the data coming into the system is going to be really, really, really important, and we might come back to that data piece in a little bit later on. But John, I might bring you in now. So we've spoken a lot, and Andrew would have alluded to it at the outset around what Revenue are going to do with this data. And the reality is this is all about increased compliance and ensuring that, notwithstanding this is intended to capture non-taxable items, there's obviously a perception, rightly or wrongly, with Revenue that there is probably stuff falling through the cracks that probably should be taxed. So certainly in preparation for the reporting coming in January, it's really important that employers are comfortable that they're compliant in this space. So if we take travel and subsistence as probably one of the main buckets, in your experience, where do we see the pitfalls here, and where can and do employers get it wrong from a PAYE perspective?
Yeah, so I think the most important thing is just making sure that an employer's expense policy is up to date with current Revenue approved limits. So if I look at unvouched travel and subsistence as a starting point, one of the most common subcategories is around mileage reimbursements, and they were most recently updated by Revenue in September 2022. So it's important that employers have updated their expense policy to reflect that, and they're not using historic rates when reimbursing. A common pitfall is around the application of the lesser of rule. So what do I mean by the lesser of rule? Take, for example, we've got an employee who lives in Cork, their normal place of work is in Dublin, but they're travelling to a temporary location in Kildare. Clearly, the lesser of those 2 distances is Dublin to Kildare, so only the mileage incurred from Dublin to Kildare can be reimbursed. And then maybe linked to that, it's just making sure employers aren't reimbursing for personal expenditure. So take that same employee, living in Cork, their normal place of work is Dublin, the mileage incurred from going from Cork to Dublin can't be reimbursed tax-free. And then if we move on to the vouched travel and subsistence, while these aren't necessarily going to be included in the EER submissions, in the event of a Revenue audit, Revenue would seek kind of substantial information to substantiate the business reason for a trip. So for example, that expense claim should include the client, the business reason for the trip, the attendees at the trip, and of course, making sure that all receipts are included in the claim.
Okay, I think that's an important point, because notwithstanding, Andrew spoke about the data fields earlier, notwithstanding that you don't need to actually physically put in the business description in the return to revenue, at the end of the day, these returns are going to be the base on which they ask questions and hone in on specific areas. So it's so important to have all that backup in the background, even if it doesn't have to be reported in real time to revenue. So that's the travel and subsistence, John. Then the other big area, which is perhaps going to be even more challenging for employers to report on in a real time, is the small benefit exemption. So again, as Talia mentioned, most commonly you think of your one for all vouchers. There's very clear rules that must be complied with in order to avail of the small benefit exemption. So you might just talk through some of the considerations that for employers in that context as we head into this new reporting.
Yeah, so just a quick refresher on the rules. So an employer can provide up to 2 small benefits per year to an aggregate value of €1,000. So most commonly that's a Christmas voucher, and that's easily tracked. But where we see some issues is where maybe ad hoc vouchers are provided to employees throughout the year. So while there might be a centralised process in place for Christmas vouchers, other team members or other departments may be giving out vouchers, for employee recognition schemes, raffles at staff events, all that sort of stuff. So it is important to note that it's the first 2 vouchers that can be provided tax-free. So employers might need to take a look at their processes and maybe do a master tracker just to ensure that when it comes around to Christmas time, you're not providing a 3rd voucher tax-free when you can only provide 2.
And it's probably worth mentioning at this stage that there has been significant pushback to revenue around the on or before requirement, more generally around the EOR, but particularly on the small benefit exemption, because of all the reasons that you've mentioned. Just the practicalities of actually having access to that data before a voucher is physically handed to an employee is just going to be a real challenge for employers to get right. So, Andrew, I might come back to you and kind of jumping back a little bit more into the practicalities of the reporting itself. So, it's really less than 3 months before this goes live. And if you take Christmas into account, it's even shorter again. What should employers be focusing on from a systems and data perspective over that period to get ready?
Yeah, so I think we have to recognise that it's 1 January is 3 months away. So less than 3 months away at this stage. So with that in mind, I think we need to be practical. So I think you need to look and see where you are at. So how do you do expenses? Do you have an app based and it's fully digitized and you're running Coop or Chrome River or something like that, and you've got good data? Or do you have a more paper-based system whereby somebody fills up an Excel spreadsheet and gets that signed off and then gets submitted to finance? And so that's the first thing, is to see where are you at. And the second thing is to look and see how are you going to efficiently gather in the information from the employee. So you're going to need your employees' help in most organizations to categorize it for you. So if it's that Excel spreadsheet, is there a drop down in it where people can select the different categories and get that to drive it? If it is your Chrome River or your app, is the drop downs on the app sufficiently nuanced in order to differentiate between the vouched and the unvouched and the various different categories? So as again, you collect in the information. It'll then go through your normal approvals process. And then you need to look at, okay, how am I going to, so assuming everything has been signed off and approved and you want to pay it next week, how are you going to efficiently get that into the return? So get that into revenue. And again, for really small businesses, it'll just need to be data entered. But then for your medium or large businesses, I think first thing I will be doing will be talking to my existing software providers. So your payroll provider and your expense provider, to see, have they done any work? Are they liaising with revenue? Do they have a timeline? It's unlikely, any or many will meet the deadline of 1 January, but do they have a timeline that you can work with to see how you're going to manage this, or are they not engaging and no intention of engaging, in which case you need to know that information so as you can come up with a plan.
Presumably there's going to be costs involved in getting your software provider to help with some of this stuff as well, which people will need to take into account. And you mentioned a number of stakeholders there, Andrew, and certainly that's something that's coming up with a number of conversations I'm having with employers, is around who should own this reporting process, right? Because it doesn't really neatly sit, within finance, HR, tax, accounts payable. There's a whole host of teams that could own it. What would you recommend in terms of where that ownership should sit?
Yeah, so I think initially it's probably multi-team.
Yeah.
So getting the policy right, getting the rules. I think there's people from tax, people from HR, people from finance needed to sit around that. Expenses is typically owned by finance. So the process is typically owned by finance, except when there's an audit, and in which case it falls back more towards the tax guys.
Yes, yeah.
So I think once it starts running, it'll be largely a finance with that's expenses. But then small benefit exemption doesn't fit into expenses either. That's usually more of a HR side of things. So there's a few balls in the air around that.
Okay, so maybe to kind of sum up on the EEOR piece, so Thalia, we've spoken a lot around the compliance issues, the data complexities. What other considerations should employers be thinking of now over the course of the next couple of months to get ready for January?
Yeah, so I think really the key takeaway is to understand what your current processes and procedures are and whether they can be adapted in any way to streamline the process for the business. So for example, if you are a business that currently processes expenses on a weekly basis, that means you've automatically got 4 EEO returns to do per month, and you may also have other payment streams or AP payments to individuals that are occurring simultaneously with that need to be captured, and they may need to be captured on separate EEO returns for that period. So looking at, is there any way we can alter our current processes, maybe to reduce the frequency of EEO reporting that might be required? What out of scope elements do we have? Is there an opportunity to review, changes to how we pay our suppliers or changes to how we reimburse individuals? Certainly understanding, as Andrew mentioned, the stakeholders involved and having a clear map as to who is responsible for the various aspects of the process. And then, understanding that notwithstanding you might be submitting the EEOR in a timely fashion, that the underlying supporting documentation to support the tax-free nature of the payments does not need to be provided at this stage, that you're comfortable that there's no latent compliance issues within the business. So there's sort of 2 strands really to that: a PAYE health check in tandem with maybe looking at your processes in preparation for EEOR reporting.
Okay, so I think the net message is to get cracking really in terms of that preparation. So we've discussed the importance of PAYE compliance in the context of the non-taxable items that are going to go through the EEOR. So it's probably a natural segue into kind of the second agenda item today, and that's just really around what we're seeing in terms of hot revenue topics or areas of focus. So one area that I think we've seen a big shift in focus from the revenue of the last probably 12 to 18 months or a little bit longer, what they refer to as staff entertainment. Thalia, I might just come to you in terms of, with regard to that kind of bucket of staff entertainment, just what our experience has been, what our clients' experience has been in terms of kind of the revenue pushback in that area.
So you're quite right. There's been a significant sea change, I would say, in terms of how revenue are approaching staff entertainment on an audit or PAYE intervention. So Revenue's stated policy on tax-free staff entertainment is that it applies to seasonal events such as your summer barbecue or Christmas party, and other special occasional events where all employees are invited and the costs are reasonable. So we're seeing significant pushback from revenue in recent times where there might be team events or other departmental events where not all employees may have been invited because it's not an all-firm event. And indeed, where maybe the team lead has brought out their team for a networking or team building event and have picked up the tab for that event and then sought a reimbursement through expenses for that event. And revenue are saying, well, actually, to be treated as a tax-free expense, it needs to hit the wholly exclusively and necessarily incurred bar in relation to being a qualifying business expense. So to my mind, that's a significant departure from previous practice. And certainly my view is these team building events, networking events are really critical for the business. There's a clear business rationale for having those events, especially in a hybrid working environment where that in-person connection may not be as regularly happening as it would otherwise do. So certainly we're seeing employers maybe settling where there are, say, smaller elements on the table in terms of staff entertainment, and that of itself can create a self-fulfilling prophecy in relation to what revenue's expectations might be on staff entertainment. And we saw that for professional subscriptions. So certainly, I think this is an area employers just need to be mindful of. Notwithstanding, there's clear business rationale for having certain events. Revenue are scrutinising those events more closely. And we're certainly finding it helpful to have a clear policy in place around those sort of events where there's parameters in place around the type of events, maybe the maximum spend that should apply and so on. So certainly an area to watch for further development.
And I think it's definitely fair to say there's a significant inconsistency within revenue, right, in terms of, you know, what one particular area might go quite strong on it and another doesn't focus as much on it. So again, that adds another layer of complexity, right, for employers in trying to determine how to do the right thing, right, when there's different treatment being applied. It's probably quite similar, John, in the whole area of gifts. I'm talking, you know, things like baby gifts, wedding gifts, things that we probably wouldn't have thought that much about in the past. What are revenue kind of saying with regard to those sort of things?
Yeah, it's quite similar to the staff entertainment point. Historically, we wouldn't see revenue focus on this. So where someone received a gift to mark a personal achievement or a milestone in someone's life, that wouldn't necessarily be seen as earnings from an employment, and revenue didn't typically go there in an audit. However, we are seeing increased focus in this area. So as you say, baby gifts, wedding gifts, flowers, all that sort of stuff. Revenue are kind of deeming that to be subject to tax, either through the payroll system or through the submission of a PAYE settlement agreement. Now, look, the amounts involved here aren't going to be material. So similar to what we would have seen on professional subscriptions down through the years, the path of least resistance in an audit is probably to include them in a settlement.
Okay.
But on balance, we'd probably say that the historic position should stay.
Should stand. And the other area, it's not a new one, but again, it's, you know, for any business that provides company vehicles, whether it be a company car or company vans, it's always something that revenue look at. And certainly in our experience, you know, you generally will find some sort of an issue, right, in terms of the quantum of BIK that's being applied. The rules have changed a bit recently as well. So you might just kind of talk us through that just to make sure everyone's aware. Yeah,
so again, rules have changed as of January 2023. For both cars and vehicles. So at a high level, the BIK for cars and and vans are based on the original market value, and a percentage is applied to that to calculate the benefit in kind. As of January 2023, it's now an emissions-based system for cars, and vans have moved from a 5% rate to an 8% rate. Those percentages for cars can be reduced where an employee has substantial business mileage. But again, it's important to ensure that none of that mileage includes personal mileage, and employers should retain sufficient evidence just to substantiate that mileage has been undertaken. For vans, it is important that employers aren't classifying vehicles that should actually be classified as cars as vans. So a van is a vehicle that is mainly or solely used to transport goods. There's a roofed area behind the driver's seat, and that roofed area has no windows or seating in it. So while the make and model of a vehicle might suggest that it's commercial, or the VRT rate might suggest that it's commercial, without meeting those criteria, it can't be classified as a van, and it would be classified as a car.
I think we see that all the time, where people kind of incorrectly assume, oh, well, we paid, the commercial rate of VRT, so surely it's a commercial vehicle. It's actually a completely separate test for VRT and PAYE purposes. So that's really important. Talia, the other area, again, it's not a new one as such, but it's always one that we focus on with clients, and that revenue certainly focus on, and that's the whole kind of employed versus self-employed, and whether someone that you've engaged on a contract or self-employed basis really should be treated as an employee for PAYE purposes. I know there's been kind of some recent case law and a bit of activity in this space. You might just spend a minute or so just talking us through that.
Yeah, so firstly, anytime you're looking to determine whether someone is employed or self-employed, you're applying a set of indicative tests, and those tests have evolved over time through case law. So examples of some of those determination tests might be, is there a mutuality of obligation between the parties to provide work and perform that work? What level of financial risk is the contractor bearing in relation to the activity, how integrated they are, the level of control exerted over that contractor, and so on. So in recent times, as you mentioned, we have seen a number of cases come through the Tax Appeals Commission process. And the key message coming out of those determinations are that not only is the contractual terms really important between the parties, and that needs to be described appropriately, but that the substance underpinning the arrangement also needs to be looked at in the context of those determination tests. And some of those TAC cases have found in favour of revenue. And in many cases, it might be actually because the contractual arrangements are not described appropriately, or actually some of that substance, which can be quite subjective in analysis, is not clear at the TAC determination. So one of the particular cases I want to highlight actually is the Domino's drivers case, whereby the taxpayer lost at the TAC, took an appeal to the High Court and successfully won at the High Court, and now revenue is going to appeal that particular conclusion, right? So really in the context of that determination of your contractor status, because it's such an evolving area and some of these are really topical and timely cases, it's really important for employers to consider, well, actually, who's within our business classifying themselves as self-employed, what processes do we have in place around that, and actually, what are the substance of the arrangements to ensure that the compliance around PAYE and the reporting is met.
And because I think where we see it crop up a good bit is actually because of a PRSI query. So you might have an employee that reaches out to the PRSI scope section and asks, oh, why am I getting maternity benefit, or why am I getting sick benefit, or whatever it might be? And the response from the department is, well, you're self-employed, so your PRSI contributions aren't sufficient. And that's often how the whole thing starts to unwind, isn't it? And revenue end up getting wind of it, and before you know it, you've kind of got a full PAYE audit with a big focus on contractors. So it can kind of crop up in different ways and perhaps unexpected ways, and sometimes it can actually be the individual themselves that opens the can of worms, so to speak, for the business.
Absolutely, we've seen precisely that, where it's actually the individual approaching PRSI scope section to make that determination of their employment status, and then that then is, I suppose, discussed or provided to revenue, who then enters the business to say, can we also review from a payroll perspective?
So the last thing I just wanted to touch on again in terms of kind of those topical PAYE matters is just the kind of whole thing of remote working. So we're thankfully well into the post-COVID world now, and certainly presence back in employer premises and offices is definitely increasing. But there's no doubt from businesses we speak to that there's still a significant level of hybrid working, and it's going to remain. And I know, there's probably not a huge amount of employers that have very flexible remote working policies, that allow you to work from anywhere. But often the issue is that employers don't know where employees are working when they're working from home. So what sort of issues on the tax side, Thalia, are we seeing?
Yeah, it's precisely that, actually. Sometimes it's the lack of visibilities of where your employees are based that is actually triggering payroll and social security obligations in another location for the Irish employer, or indeed for a foreign employer for individuals who've based themselves in Ireland. So, a prime example of that is, we recently helped a UK company who has an Irish branch and who hadn't fully appreciated that some of their employees were working in the Republic, and that has led to a historic payroll reporting obligation and Irish social security contributions being due. And likewise, that sort of, Republic, Northern Ireland border element can raise significant issues in the sense of how easy it is to commute over the border between the two locations. So we recently helped an Irish business who had employees working in the north to rectify some of their UK payroll obligations and national insurance contributions that are due as a result of these employees inadvertently working from the north.
Yeah, so it can kind of work both ways, can't it?
It works both ways, yeah.
Thanks, Thalia, and thanks, John and Andrew, also for your valuable insights. So in terms of key takeaways on the general revenue hot PAYE topics, it is worth considering whether now is the time to conduct a PAYE health check for your business, if one hasn't happened for a while. The rules and PAYE landscape are forever evolving, so it really is important to ensure that policies and procedures are kept up to date to support ongoing PAYE compliance. On the EEOR, we would recommend that as a first action, a decision be made internally within your organisation as to where responsibility for EEOR will sit. It is important that a specific employee or team is given ownership for the rollout and continued compliance into 2024, essentially to ensure that this doesn't fall between two stools. Secondly, now is the time to reach out to any third-party expense software providers to understand what they have done, if anything, to get ready, and to what extent your business can piggyback off those developments. Thirdly, employee engagement will be vital to enabling employers to comply with these new requirements. So this will require a review of existing policies and procedures to ensure that the data is recorded and tracked in real time to ensure that this reporting can be completed on time. Thank you for watching today. I hope you found it useful. If you have any follow-up queries, please reach out to myself or any of today's panelists or your usual KPMG client team.